equity is a really complex product because it's not just the product or service that your business is selling. It's a constantly moving picture of where your business is today, where you are today. And that individual or that's making a decision as to whether or not to proceed with something or to build that conviction is going to have to do that over a period of time. And so many companies that are doing investor outreach try and almost expedite that process into I'm going to reach out to everyone and I'm kind of going to present them with a yes-no decision on a really complicated product that I'm going to try and sell them without focusing in the time and attention that it really takes to build that relationship, help that potential customer, that potential buyer essentially of your equity, build that conviction, and they sort of skip that part. And therefore, yeah, you can reach out to thousands. It's not necessarily a numbers game. It's actually it's a time and quality game. And it's which relevant potential buyers at the top of your funnel are you actually putting there and spending the time on?
Most founders spend months sending cold emails to investors who never are the right fit. They waste time, they miss energy, and they knock on the wrong doors. Daniel looked at this problem and asked, maybe there's a better way. Maybe there's like a Google search for investors. So today he's the co-founder and CEO of ShipShape.VC. It's a free investment search engine that's already helped thousands of founders connect with the right investors across more than 25,000 funds. I'm sure this number is a little bit bigger because this is from my research. His mission is to make fundraising smarter, faster, and even fair. So Daniel, I'm very happy to have you here.
Thank you so much for having me and inviting me on, and yeah, giving us the chance to share our story.
For sure. I'm so intrigued. What got you here?
I made a mistake. is the honest answer. I joined a tech company, and the CEO and founder said, Daniel, you're good at research. Go find which investors we should be speaking with for our Series A. And I very quickly realized that actually products that are out there weren't priced for founders, and they weren't built for founders. And yes, you could go and get a generic long list that in theory you could spray and pray to, but actually that was going to be a huge waste of time in terms of which of those investors were actually interested in the niche that we were building at the time. So we were successful in the end with that Series A, but the time it had taken to go and identify the relevant investors was out of all proportion to essentially like the cost essentially to the business. It was a really high cost, and obviously many businesses don't make it. And many of those that don't make it probably could have done had they taken a different approach with the way that they were conducting their investor research.
And you're so right. There's so many famous founders that went to like 50 people or 100 people, and they weren't able to raise money. And raising money is usually when you cold outreach, everyone says no. Everyone. This like the no becomes part of your lingo. How did you start thinking about, okay, there needs to be a better tool, but then there also needs to be better ways of introduction, or what was that approach like?
So I think the way that many approach this problem is your top of the funnel is absolutely ginormous if you're following a sort of spray and pray approach. And therefore you don't actually have the time to properly take a potential buyer of what is ultimately a really complex product. Like equity, even for investors who specialize in purchasing equity in your business, equity is a really complex product because it's not just the product or service that your business is selling. It's a constantly moving picture of where your business is today, where you are today, and that individual or that's making a decision as to whether or not to proceed with something or to build that conviction is going to have to do that over a period of time. And so many companies that are doing investor outreach try and almost expedite that process into I'm going to reach out to everyone and I'm kind of going to present them with a yes-no decision on a really complicated product that I'm going to try and sell them without focusing in the time and attention that it really takes to build that relationship, help that potential customer, that potential buyer essentially of your equity, build that conviction, and they sort of skip that part. And therefore, yeah, you can reach out to thousands. It's not necessarily a numbers game. It's actually it's a time and quality game, and it's which relevant potential buyers at the top of your funnel are you actually putting there and spending the time on? And then, like we like to sort of talk about it internally as sort of what we want to do is try and persuade people who are trying to sell cruise ships, not to try and sell to people who are actually selling ice creams and are never going to be interested in buying a cruise ship.
You're so right, and I like how, in simple terms, you've put it. Equity is an incredibly complex product, and we try to formulate a yes/no, yet investors, the no is a default. It's almost like, tell me enough so that I can come to a yes. And I like how you put it's proportional to the time quality that you put with that person, because really there's so many moving parts, there's so many things that can go wrong, and so many things that have to go right for anything to go right. So what was the origin? What was like that, okay, you were in this company, you were tasked to find investors, to do research. Every tool was prohibitive because of cost, and I've been there. I've seen databases that cost $20,000, and you think like, okay, this is shot in the dark anyway. So how did you start your new venture, and what was like that first, like, okay, I need to do this first?
Yeah, it's a great question. So one was going through that painful process in the company prior to ShipShape, and the other one was actually COVID. And in the UK we had a lockdown, like many countries did, where basically you weren't moving. And I was lucky enough to spend it in a beautiful part of the UK in Wales. And Wales, whilst it's beautiful, has seen better days economically, but there were loads of tech-driven responses and new businesses being formed that were doing like pharmaceutical deliveries to the doorsteps of the vulnerable, or like farm to fork, or like from sea to your home in terms of delivery. And some of these businesses were great, but Wales is dislocated geographically speaking from London, like the UK's financial centre and one of the global financial centres. And it became really clear to me that actually this is fundamentally it's a long tail game, right? So if you think about YouTube and what individuals each watch, it's really, really different. And so it sort of dawned on me then that actually, okay, if you're building something super niche within, let's say, cancer detection technology, actually what you want to do is you want to have the maximum number of interested buyers on the other side of the table who actually really understand that market, because they're going to be able to better price and build conviction in what your business is doing. And what they won't do, you see some regional investors sort of do this, and it's not to poo-poo all regional investors, but essentially specialist investors understand the market, they understand the risk better, and they're less likely to discount the business and the valuation that they give you, because they actually understand what the potential of your business is. And so I was thinking about that and that problem, and how do you solve that? And actually, if you can pick up what a fund like thesis is, and the themes of that thesis, and the types of companies that they consistently want to invest in, and types of technologies that they want to invest in, it's a long tail search problem. And that sort of dawned on me in thinking, okay, well actually what you could do here is almost make a global village for the people who are building in a particular space, to enable them to find, okay, here are the sources of capital that actually directly focus on investing in opportunities like this. And that way you can actually massively reduce the fact that, okay, you might not live near New York or San Fran, but actually you can still have a conversation with an investor that's super interested in what you're building. And if you can essentially, it's overused, but if you can democratize access to that type of information, you can genuinely change the way that a market functions.
And I think so you're saying it's really the thesis driven, where you find 25,000 funds, you ask them, what is in your buy box, what are you looking for, and the guy in Wales or in South Africa can say, hey, I have an idea for this, and then he can find all of the funds. He might say in Wales or in South Africa, wherever he is, or in Ecuador, where I'm from, like, oh, I never knew that I could raise money, because in Ecuador I don't have access to this money, but there actually is, look at all these 100 funds that might consider my approach, my solution, or whatever product that I'm trying to bring to market. I think it's very interesting. I tend to say, don't sell meat to vegetarians, and this is exactly what your product is doing. I find that when someone tries to, and there's buckets I've seen in the investor world. The people that are very VC focused hate real estate. The people that are real estate focused, they hate VCs, and both hate crypto people. They're like, I don't understand you, but you don't. It's not a hate or love or one is right or one is wrong. Everybody looks the smartest at one point of the cycle. You just need to find your tribe, and I think that's what you're doing.
Yeah, I mean, like, as I say, I think preferences are. It's now possible to have really niche preferences for just about everything in life. Everything from who'd have thought, I don't know, 15 years ago that there's some guy in Alaska who records survival videos who's able to make enough income from people watching those YouTube videos from around the world based upon him going out like ice fishing. Like that 15 years ago would have been insane, but because of preferences and the way that we get to consume media now, actually people get to express those preferences, and ultimately those again, it's a supply and demand, it's a marketplace, but actually we're getting better at expressing those preferences. So you might be a brilliant student from one of the universities in Quito in Ecuador. You might be brilliant in satellite design, but there aren't that many local funds in Quito who specialize in space tech, right? But there are plenty of others around the world that would be interested in taking a look.
Yeah. So this great idea. What was the first story where you're like, "Whoa, this actually worked"?
Quite honestly, it was the first prototype that we built was in Excel, and we literally built a glorified Control F function. This is pre LLMs, pre things like Lovable, etc. So we were really hacking together something. We basically got a few thousand Medium articles where we knew who the investor author was of those Medium articles and other types of blogs. We basically put those all into this great big Excel spreadsheet and used Control F to see which investors had been talking about cancer detection. So the founder of a business had paid us £100 to go and find which investors around the world within our much more limited data set had been speaking about cancer detection technology. And yeah, that company ended up getting investment. Actually, the founder of that company ended up investing in us off the back of that. So yeah, first paying customer, but also one of our first investors because they had seen the benefit and the upside from it.
That's amazing. What other stories come to mind where you're like, I understood the idea, the first customer became an investor. Was there a story that you were like, I never thought this would get so big, or you never thought that these people were connected that you feel very successful about?
So, can't prove it at the moment anyway, but because we don't basically so founders use us for research. What we don't see is we don't see the whole of the transaction. So we don't know whether or not we were the cause of a company successfully raising. But we actually partnered up with a data-driven VC fund called Cobalt, and they basically ran some analysis on the first 1,500 companies that had used the search engine to see, okay, where are they now? One of those sort of TV shows on looking back at famous people and seeing where they are now, and they ran that analysis, and it was probably about it was a year after we had that initial data set, and those companies had gone on to raise over 1.5 billion USD. Since they used our search engine, and we had anecdotal feedback from founders saying, hey, actually, you may not know this, but one of the investors we found through your search engine took part in our round, and just want to say thanks, because that wouldn't have happened most likely unless it had been for the search engine.
And going deeper into your business model, you said free, you don't see this transactions, and why did you decide this? Are you happy with it? And if you could go back, would you change it, or are you like, this is the best decision we made?
Definitely the best decision we made. It didn't seem like that for a very long time. Initially, we were thinking about charging founders. It wasn't the intention in the long run, but we needed to prove that there was some perception of value, essentially to build credibility and conviction with investors, so that they could say, actually, I can see how this can make money. We flipped that though, because we were essentially competing with like a PitchBook and a Crunchbase model, and trying to get to the same scale of data is difficult. We're getting there now, but at the time it was really, really tough to do that. But so we flipped it around to a free model, and the way that we monetize is that there are both public and private organizations out there who want to help and be involved in the journeys of these businesses and help these businesses succeed. So we work with, for example, both national, regional, and local government, where they might want to attract companies outside of their country that fit certain sectors that they're trying to grow locally. So let's go through a real example here. Let's say you've got like a cloud encryption business based in the UK, and they want to expand to the United States. They may not know where in the United States is actually the best place for them to set up. They'll know New York, they'll know San Fran, but actually, if their customer base is mainly government, they should probably be thinking about like around DC. And so we work with government who want to attract those types of companies into their ecosystem, so that they can basically target like really super specific companies that are perfect fits for like the ecosystem around DC, for example. We can let them basically market to those types of companies, and that's where we monetize. So we help both public and private sector organizations market to those companies in a much more effective way, because we're picking up the intent signal that actually a company wants to grow. And it means that the company doesn't need to pay, because hey, if you're fundraising, you don't have like a lot of money to throw at your investor research database. But actually, these other organizations have got significant marketing budgets that they're spending on things like conferences, or like hosting dinners, or like going on very expensive international trips to try and pick up those types of future customers for them. Doing it this way, we pick up the intent, we help them be super targeted, and personalize their outreach to knowing what that business is going through and what help that business might need in that growth journey. And so ultimately we see it as like a massively mutually beneficial alignment of interests, including for us, in that exchange.
Was this day one, or when did this present itself as like, okay, actually this is a much smarter way to monetize and be part of the ecosystem, and at the same time being true to the problem you originally had at the first company? You said, well, I cannot pay PitchBook. I cannot pay those fees. It's a little bit too expensive, and there's no, success isn't guaranteed. So keeping it free.
So I think we sort of fumbled our way to it, is the honest answer. So we pivoted business model. We changed the way that people were able to buy essentially that type of marketing intel from us. And honestly, I think we're still learning. So whilst we're really happy with the model, you're always making tweaks to it. Like there are certain types of organizations that can't necessarily afford to pay you massively upfront, but there might be some upside if there's a commercial deal that then happens. So we're still learning, is the honest answer. And whilst I think the model's set, we're never going to charge the founders. That's we just don't want to do it, and we think that the world is a better place and a better future happens faster if you give the people who are building that future better information on who they should be spending their time with, and to minimize the time that they're spending away from the business because they're focused on the round. We think that's, one, the moral thing to do, but actually, two, we make the market bigger because more transactions can happen and there's greater visibility as to actually venture is a great place to allocate capital to because the market is more transparent about the types of assets that you can buy.
100% agree. Once you started, were there misconceptions or perhaps irrational things that you didn't know that fundraising has, that you're like, okay, I wish more founders know about these fundraising mistakes that you've seen on these past few years?
Very much so. One nearly killed the business, and we had to downsize the team after it. So we had engaged with a family office that was setting up a fund, so we thought, and what we didn't realize is that one, a fund needs to be, there's like a significant time frame in which a fund requires to get authorized, and two, actually you should be looking at evidence of previous investments to prove that actually a fund is genuine, and that you should be thinking about the fund's life cycle as well. So what funds are really good at is creating a brand name, or many funds are really good at is creating a brand that's out there that you think is ever present and ultimately isn't going through its own shifts. But the way that funds are working is that, they're taking a pot of money from their investors. They've essentially got an allocation and LP commitments, so commitments of cash over, like, let's say, a 10-year time frame. But they're not investing for the whole of the 10 years. They have a sowing and a harvesting phase. And I think many founders, ourselves included, don't necessarily know that day one, and it's really difficult to sort of wrap your head around. Okay, you've got all this money over here, but you're saying that we're potentially not a fit because you're actually in a different phase of the fund. Like, I just don't get it. So I think bearing in mind where a fund is in terms of its life cycle is really important. I think education's getting better for founders now, but definitely when we started out, we felt quite amateurish when we were speaking with funds that were just never going to deploy into a business like ours.
And is that part of like the search parameters? If someone goes into your site, they can say, I need to see funds that are interested in my niche, in my type of geography perhaps, or check size. What other categories aside from fund lifecycle do you feel are extremely important to filter from?
Yes, so we prioritize funds where there's evidence of recent activity. So that's one of the things that the search algorithm will automatically prioritize. It'll be looking over the last 6 months, is there evidence of activity? If there's not evidence of activity, then we will deprecate that search result. It doesn't mean that the fund isn't active, but it's just that we've seen no evidence that they are. And we also try and highlight funds that have also raised and have announced that they've raised a fund within essentially the last 3 years. So we want founders to be able to see that type of information and see that, yeah, fund's active, yes, they've raised recently. That information we're still like populating in, especially on the fundraise side, because it's not always public. But yeah, that's information that we want founders to have and not need to go and sort of like spend 4 or 5 hours on the web to see, okay, like what's the background of this fund? Have they raised recently? Like, what was the last transaction that they actually did? And not everyone can afford a subscription to like essentially but TechCrunch Pro or whatever it is these days. So again, like there are these cost barrier to entries that are really restrictive for founders and ultimately make the market smaller than it ought to be.
Yeah, I can't help but think that founders and investors is sort of like a matchmaking, like romantic matchmaking. It's even the more you know about each other, the easier it is for a transaction to happen. And as an investor myself, the hardest thing to overcome is when a founder has not done due diligence on us. It's like and it's a two-way street. I think this is we get pitch decks before, we look at everything they've done, we've researched the founder, we've researched the product, the product market fit, go-to-market strategy. Everything gets vetted, and then when you get to the meeting, you're like, oh, why would you take our money? Because it's not only money, it's most. I wouldn't say most, but there's a lot of there's all flavors of VC or investors, angel investors or family offices, and everybody's going to have a different level of handholding, involvement, approach, and I feel that founders mainly want the money and not necessarily think, oh, if I partner with this person, they might 10x my company, because their money is actually, I don't want their money. I want their expertise. I want their connections. I want, there's so much more to that.
Yeah, and I think that's, I think many founders going into a funding round, they're doing it primarily for the capital because they've worked out on a spreadsheet that that's how much they think that they need, right? And so they're going into the transaction with that most of the time being like a primary motivating factor. And I think actually the historic way that there's not been so much access to data has driven a lot of that approach, where founders don't feel like they essentially have tried to create a top of the funnel that's too wide for them to be able to properly research the funds and the investors that they're engaging with. And yeah, I think that massively deprecates the perception of the founder in the prospective investor's eyes. Because if you take it, let's say you want to contact the entire universe of investors, some of the investors that you speak with will actually be potentially ideal. But if you've given them the same lack of time as an investor that's not ideal, you quickly get discarded from their funnel, right? And I think that's it's a tragedy that's the case. And actually, one of our best investors and angel investor we actually found using our own search engine, that he was interested in data science and venture capital, and he worked at Greycroft and Balderton, who are like a household name here in the UK. But we saw that he was interested in data science and venture capital, and we essentially built a relationship with him, not necessarily thinking that he was going to invest. He actually became it's a completely separate example, but they became a customer first, and then down the line, he wrote us a check. Wasn't a massive check, but phenomenally helpful in terms of like the connections, and also I suppose the kudos within the industry of, okay, actually this person who everyone regards as being like really clued up on data science and venture capital thinks that this company's worth investing in. Like it's a great signal to the market. But again, it's because we sort of done our research. To your point around like who's going to drive the business forward if you're ignoring capital.
I really like your point of, if you spray and pray, you might spray the wrong way to the right person, and then you might get stuck with, well, you already alienated the right person to you. Whereas if you spend the time like a client or approaching someone in a more friendly manner, not only a check might come, but also, like you said, the kudos, the connections, the network, the validation, possibly even friendship that comes from that. And that's like a virtuous, like the side effect of being in the industry.
Yeah, I couldn't agree more with you, and it's like there is a common saying, or at least I now hear it a lot. At least many founders like just starting out perhaps don't, but investors are investing in lines, not dots. And I think many companies, particularly those that aren't essentially doing enterprise sales for their product, treat the sale of their equity as part of their fundraise as almost like a B2C play of, I'm just going to put it in front of as many eyes as possible and we'll see like who buys it. But actually I think it's much, to exactly the point I think that you're making. This is much closer to like an enterprise sale. You've got to take your time, you've got to be patient, you've got to have the right approach to the right person in the company, in this case the fund, but really have done your homework about, okay, not just is the fund the right fund, but who's the person at the fund who's going to pick up the torch and be your champion, because they're going to need to persuade their colleagues that their limited pool of capital is best put here, and that you need someone who's going to go back for you.
Oh yeah. I remember one of my mentors gave me a phrase that helped me raise money, and it's been one of those, like, not magic trick, but definitely one that has helped me increase, or at least deepen my relationship. Is like, you never ask for money, you always ask for advice, because the minute that you ask for advice, they give you money, and when you ask for money, they give you advice. And I think founders, like you said, that B2C model of let me put like ads in front of you and say why I'm the best, and then at the end it's like, hey, I need 500K to get this done. Most founders would be like, but have you thought of, most investors would be like, but have you thought this? Have you thought that? Have you done this? Have you done that? Have you thought, this is not for me. Whereas if you're like, hey, I have this problem, what would you do? And they'd be like, oh, I would go to this market, and then I would try this product, and then I would do this feature, and this would cost maybe 500K to do, and this sounds really exciting. I'll write that check for you. You know, it's like it's a different approach to fundraise.
Yeah, I think it's the right approach as well, and I think that then sort of underlines the point of, okay, well, not just thinking about it from an investment perspective, but okay, who are the people in your industry that you would ask for advice from, and almost like start there, because but and I think that's sort of, I think there's a deeper, I mean, we've got sort of a hypothesis internally that actually the market should become more specialized and will become more specialized over time as funds and GPs are looking for, like, there's increased competition for LP cash, and therefore they need to differentiate themselves from the next fund that comes along. So one of the best ways obviously to do that is to leverage industry specialisms. And so we think actually the market's probably going to get better for founders to be able to find funds that do really know the industry that they're operating in. So actually for founders it should get easier to ask for advice from people who actually understand the industry and the market and the domain that the company's building, which I think is a really encouraging sign for the future. Just to go off a slight tangent, we're building an LP search engine so that GPs who are raising a fund can essentially research which LPs out there seem to have a particular focus or thesis around what types of funds they like backing, particularly around industry. So we're largely picking up, corporates that are potentially cornerstones for certain funds, and that's one of the things that we've done is released a waitlist for that. We've asked funds, okay, what type of thesis have they got? And I think there's for me at least, there's a bit of a surprise in terms of like 5, maybe 10 years ago, you had lots of generalist funds who would invest in quite a lot of different industries and sectors. What was quite interesting about that LP search engine waitlist is that the vast majority of the funds are not generalist. They're really going deep down into like battery technology for like wind turbines or defense computing, for example. Like there are some real niches emerging, and that these funds are concentrating on. And I think that's it's just a really interesting phenomenon to see as the market's evolving.
It is interesting, and I think there's part of it stems from perhaps the irresponsibility of discretion funds and how we are in a winter. The cycle has been pretty hard on founders. It's pretty hard on GPs. They cannot find LP capital, and every LP capital seems to be flush. It's like they don't want to. There's so much capital on the sidelines waiting for something which gives them a signal to go back in, or cheap capital to be back. But I think that's what caused being specialized. At the same time, I don't think specialized necessarily means the best thing. Like when in our fund, we believe flexibility creates overperformance, because if you're niched and then something changes and you cannot, if you're too rigid, you might be wiped out. And I think that makes it, like in my brain at least, it doesn't work like that. And I think, and I've seen so many funds, and I'm more in the real estate space, so it's a little bit different, where people are like ultra specified. I do multifamily in this sector, in this vintage, for this class, for this type of like it's very, very niche, and then the market completely shift, and they're still doing it. I'm like, but you're drilling yourself to your grave. But then I started to understand, but they're a fee business. They don't care if they're going to the grave because they're still charging their fees. How do you see that evolving with the funds that you work with and the GPs and the LPs?
So I take your point around flexibility in certain like asset classes as being the name of the game, but I think if you're focused specifically on innovative technologies, then actually I think specialization is the right approach for a fund. even if it means that you're building up like you're building a big fund, you're growing your AUM, but actually you're building up multiple specialisms within the fund. So you've got individuals within the fund that really know like certain markets really well, even if you're sort of pooling that risk underneath a larger logo, if that makes sense. And I think that in part because if by definition the world of venture is innovation, then you've kind of got like this body of knowledge. It's almost like a sphere, and people are adding to it in certain areas, but actually the area that you need to cover is getting larger and larger and larger. So if you're trying to cover the whole thing, you're unlikely to be able to add like lots of value because you don't have the domain knowledge, and actually domain knowledge is becoming more and more valuable because the area that the sphere is now covering is larger. And so actually, again, I might be proven wrong, but the hypothesis we have is that actually as we have like the body of knowledge is increasing, actually specialization becomes more important in terms of trying to impact the outcomes for the companies that are being invested in. I think particularly on like, deeper technologies.
I agree with you. I just said there's two waves. Like it'll go specialized, and then as money becomes freer or cheaper, it'll go back to generalists and these massive funds that they're just like, what do you invest in? And they say technology, or they say, medicine. It's a blank statement.
Yeah, founders, you want to change the world. Okay. Yeah.
Founders that think different. How do you feel? So it's really cool what you have, because you have a pulse on what founders are looking for, what funds are looking for, and what LPs are looking for. Is there any trends that you think today are really interesting aside from this specialization?
Yeah, so I think there's a very interesting phenomenon that we've noticed, because we're used by both founders and also by funds who want to see potential funds that they want to syndicate on a deal with, or there might be a portfolio company that is going through their next round, and they're thinking, okay, like who else can we put them in touch with? And indeed, like thinking about those horrible market maps that funds are created, or funds often have some poor like MBA student or analyst go and create for like, here's our market map for this. So yeah, we kind of get intent signal data from both sides. So not just the founders who are raising, but also the funds. I think what was interesting is that the sort of AI wave, if we can call it that, you had funds putting more AI-based searches in first. And then you saw almost like an overreaction from the other side of the market that had seen this like these huge signals of where very large amounts of capital were flowing into in the AI space, and then you start seeing founders say, actually, we're an AI-powered, I don't know, cat flap business, for example, and like the shoehorning in of what they think is the phrase that's going to make it easier for someone to part with capital is an interesting trend, and we definitely saw sort of an overreaction from the founder side of the market to that, because yes, immense amounts of capital are going into AI companies, but actually it's a very small number of companies that are taking a very large amount of capital. It's not actually that the bets are becoming more common, it's that actually the bets are just getting larger. And I think that was a really interesting phenomenon to see from the search engine, was actually be able to track that. And yeah, I just think because it's becoming so essentially commoditized, or at least lower levels of AI access are becoming more commoditized. Ultimately, it's going to become the same as saying, like, oh, I'm an electricity-powered business. Like, yes, of course you are, but what is the problem you're solving? It's a smarter cat flap, that or whatever it is.
That's hilarious, and I do feel that there are buzzwords that come, and going into the AI conversation, there's so many people that think AI will do it, AI will do it. I'm like, yes, do you remember 20 years ago we used to say Google would do it, Google will do it, and we're still working, we're still doing things, we're more productive than ever. We just need to embrace this, and at the same time not use it as a buzzword. Like you said, this is an electricity powered company. I find that hilarious, because then, yeah, but what do you do?
Yeah. What's the problem you're solving, and for whom? And I think that's so much more important for companies to focus in on it. And ultimately, your customers are unlikely to care; they just care about the result, right? And that's
for sure.
I think it's quite interesting to see that way, from seeing where we are.
What part of your work is invisible to the outside world, but you know it's maybe one of the most important?
That's a really good question. Location. Location's really important, and don't think it's not just from a fund perspective, but from where businesses are based. So, why is that important? And can I give an example of how that's powerful? Yes. So, companies, when they use the search engine, we ask them for their zip code, and one of the things that we do, and this is a free product essentially for regional growth bodies and economic development, basically. Let's say that you're the state of Maryland, or you're a county within the state. You've got some amazing businesses, some amazing tech companies that are really fast growing. They've got huge ambitions, but as the state, you very often have sort of incentives for companies that want to grow their business in your state or in your county. And historically, lots of those incentives have gone to Chrysler's going to set up a big manufacturing plant, and the state is going to give you 200 million in incentives. Great, everyone's happy, you've created 1,000 jobs. But actually, from a future growth and prosperity perspective, one of the things we do, so a company uses us, let's say they're in Maryland, or Colorado, or somewhere else in the United States, or Tennessee. What we do is we can let the economic development team that looks after things like grants, like incentives, like tax credits, etc. We can let them know, actually, hey, there's a really high growth business in your jurisdiction that you probably didn't know about, or even if you did know about, you didn't know that they're raising significant sums of money, and they can potentially transform that local economy where they're based. And we can let them basically be proactive in supporting high growth businesses, and we do that for free. So we let that local government, the body that gets to disperse those incentives, we let them know, hey, there's a company here that's doing AI antibody discovery. They're raising 25 mil. And what that can really help with is, okay, the state or the county might be able to give 5 million in incentives. And for the business, that's totally transformative, because instead of saying, we're going out to raise 25 mil and we're at zero, they can go out and say, actually, we're raising 25 mil, we're at 5 million in commitments. And so to help crowd in that.
And by a legitimate money source, a very legitimate money source.
Exactly. So that's something that we're, people don't see until they get a inbound from someone who works in economic development, or works at the grant dispersing body or the incentive dispersing body. We very often let them know, okay, there's a brilliant company that wants to grow. Here's not a bad place to place that bet from a public money standpoint.
No, that's amazing. Where do you want to take your company? Where is the next 5 years? Where's the next 10 years? What does that vision look like?
So really excited for the LP search engine. We think that's going to add another layer of transparency for those who are raising funds. We've got companies that have used us from over 100 countries globally, and we want to grow that user base. We're at about 5,500 companies that have used the search engine in sort of 2.5 years that we've been live. That's growing, and we want to grow faster. We want to create a more transparent market ultimately, and enable more founders to tap into that intelligence and spend more time solving the problem that they got into it for. And I think one of the things that we need to do is come up with better metrics for, okay, we say we want to make a better future happen faster. How are we measuring the improvement, essentially? And yeah, but I'm also just really excited for how we can, rather than some of the other databases I mentioned are retrospective in the type of data that they that they essentially sell access to. What I'm really interested in is, okay, you can see where the supply of capital's gone. Great, there are loads of sources for that, including us. You can access it for free. But where's the demand for capital coming from? Like, what are the new sectors that we're seeing that have got that demand for capital? Which parts of the country is it coming from that actually you can then see are massively dislocated from capital? And we see this actually we see it in our data, locations that are really dislocated from centers of financial capital. So like, we're going to use Wales again, just to go back to sort of like to where our company is, where this sort of calls home. A company raising £500,000 round in Wales can expect just over 22% dilution. In London, they can expect 13%. And so the outcomes and the possible trajectories for those businesses are entirely different, because actually one business has got a lot more equity to sell in the future, and they achieved a higher valuation earlier. And so that progression looks very, very different. And I think capturing that intent data, capturing that demand for capital data, is just a really exciting field, essentially of study, I guess. We're studying that data. We're looking at we're doing a research project at the moment, looking at, for example, there's there are lots of studies about the supply of capital and the proportion of that gets allocated to female-founded businesses. One of the things that we're doing with our data is we're going to have all sorts of biases about the way that our distribution network means that inherently we'll have certain over-representations. That's fine, we accept that. But we're looking at, okay, of the companies that use us, what percentage from a demand for capital side has come from female-founded businesses? Because I think it's unlikely that there are only 2%. We know that there aren't only 2% of businesses that are female-founded. It's actually we're about 2,000 companies that we've analysed through, and it's about 11% of companies are purely female-founded. What we haven't yet done is, okay, what's the average ticket size that or the round size that they're raising? Are there any interesting phenomena around? Are there particular sectors or domains that actually male-founded businesses tend to be sort of overrepresented, etc.? That demand side of it, I think, is underexplored, and we've got a really cool data set that would be a tragedy not to at least just put it out there, not take a political stance to it, just say, hey, our data says this. We can let other people decide what they do with it, but we can at least put the data out there. And that's something I'm really excited about it.
It's very exciting. And it's also just heat map, trends. Is there a reversion to means? Is there what ticket sizes are being asked at where? There's so much data there, and I hope that you put it out there, because it's definitely interesting for everyone to know this has always been a private market, so no one knows what's happening. Even the big players in the space, it's very cloak and dagger. There's a lot of yes, when a big VC makes an investment, for sure, but early stages, it's very unknown.
Yeah, I think there's a tech investing media, especially at earlier stages, has a distribution problem, because let's say that you're building osmosis technology and you raise a 300k round and you're based in Arizona. There's no way that a TechCrunch is going to cover it, but actually there are probably 100 people around the world in the tech investment space who would find that piece of information really interesting. But because it doesn't sort of fall into the lowest common denominator attention grabbing category, it doesn't get the coverage, because ultimately it's not going to sell enough advertising for the slot or whatever the monetization model is. But I think that's a huge missing gap in the way that the ecosystem's functioning on news and media. It's very lowest common denominator, what's the big news, rather than actually, we know that you are really interested in this very specific niche. Something small has happened in it, but actually for you that could be a really big thing.
Yeah. And what you said before, the media sprays and prays to the biggest common denominator because it'll get the most results, whereas what you're doing is the complete opposite. For the the person extremely interested in osmosis, this is going to be the biggest nose. And for them, it makes the biggest difference. Daniel, it's been a real pleasure to have you. I think what you're building is super interesting and really needed in the world of investments and alternative investments, especially the VC world. I'm very excited to see where you take this, and hopefully to have you back in a few years and give us some more war stories and some victory stories.
That'd be great. Ahmad, it's been a real pleasure to have this time with you.
Thank you so much.
Thank you.